Hello Maverick traders, this is Imre and welcome to this video on identifying core corrective patterns. Today we're looking at the flat pattern. Alright, so in terms of Elliott wave corrective patterns, the flat is one of the core patterns and there are three variations to the flat, and we're going to be taking a look at all three of those variations today. So this video is a continuation in my series on impulsive waves, corrective waves. We've looked at both kinds of waves and we're now taking a deeper dive into the different permutations that corrective waves can take on. And the good news is that there is a finite number of patterns. That makes our job as technical analysts a lot easier, because once you understand that there are only a finite number of patterns and that they each have their own rules, you can start building a systematized trading plan around those patterns. So here's some of the other core corrective patterns. Right? We've taken a look at the zigzag, we have the triangle here, and then we have the flat. The names are fairly self-descriptive. You know, the triangle does look, in fact, like a triangle. The zigzag looks like a zigzag, and the flat is what in classical technical analysis we might call a double top or a double bottom. All right, so let's get into the flat itself. Now here are the rules governing the formation of a flat. Flats always subdivide into three larger waves labeled using the letters A, B, and C. Now wave A, let me back up a second actually. So the flat is what I would call a 3-3-5 pattern, which means that wave A and wave B of a flat will unfold in three waves of their own, also labeled A, B, and C. And then wave C of the flat will unfold as a 5-wave pattern, right? Labeled 1, 2, 3, 4, and 5. So wave A of a flat will always subdivide into either a zigzag or a flat itself. Wave B will always subdivide into either its own zigzag, a flat, or a triangle. So wave B has this added wrinkle of also potentially unfolding as a triangle. Wave B will always retrace at least 80% of wave A. And then again, wave C will always subdivide into either an ending diagonal or an impulsive wave. So that 5-wave movement. Flats are considered sideways corrections or time-based corrections. So if you're unsure, about the nitty-gritty of the flats, what you always want to be looking for is this kind of sideways flat channel type of formation. That's usually a dead giveaway that you're dealing with a flat or a variation thereof. So here are some of the guidelines, if you really wanted to get into the details with this. So wave B usually retraces between 100 and 138% of wave A. Wave C is actually typically a little bit longer than wave A. So a really interesting feature about the flat pattern is that they tend to be two-way traps. They tend to trap bulls and bears before the market eventually takes off in the direction of the larger underlying trend. So like I mentioned before, flat patterns look like your typical double, triple tops and bottoms. And when wave B is more than 105%, as long as wave A and wave C ends beyond the end of wave A, the whole pattern is called an expanded flat, which is one of the variations. Now, when wave B is longer than wave A, but wave C does not end beyond the end of wave A, that's called a running flat. So expanded and quote-unquote regular flats are far more common than running flats. Running flats are quite rare. If I had to put a statistic to it, I'd say they take shape roughly about 10 to 15% of the time only. So here we have an idealized line diagram showing a regular flat formation. Wave A is a zigzag, wave B is a zigzag, and those subwaves are labeled with the parentheses letters A, B, and C. And then wave C unfolds as a standard impulsive wave, 1, 2, 3, 4, and 5. So this is how traders get trapped with flats. All right. As the market breaks to new lows below this parentheses wave A, and we're completing wave C of the larger degree wave A, the market is going to go short. And then they're going to get stopped out as the market breaks higher in wave B. In fact, this is where a lot of traders will go long because they'll think we're about to break out. And then they get trapped again to the downside, as we trade lower, and we usually get stopped out when the wave C moves beyond the end of wave A here. That's also where a lot of traders are going to go short the market because they think we're about to break down below support, and then we get a larger move to the upside once wave C completes as the larger bullish trend resumes. So this is a bullish continuation pattern in this particular diagram example. And then here's another example of a flat. This time, this is a bear market continuation pattern. So again, we have wave A. The market will go long in wave A. They'll get stopped out with wave B. And then the market's going to go long again in wave C as we break below that wave A extreme right here. And then, like I said, because this is a bear market continuation pattern, eventually we're going to see a strong trending movement to the downside. So this variation is an expanded flat. Why? Because wave B goes below the origin of wave A over here, and then wave C exceeds the price extreme of wave A over here. So expanded flats are, very, very tricky because they tend to trap traders a few times. And now here we have a running flat variation. So wave A in this case is its own flat, A, B, and C. Wave B is a standard zigzag. Notice how wave B makes a slight new price extreme relative to wave A over here. And then wave C does not make a new price extreme below the low of wave A. So this is a running flat. Running flats are usually a sign of hidden buying or selling pressure. So in this case, because wave C could not even break below or meet the wave A low, we can expect a surge of buying pressure to the upside. Okay, so now taking a look at real markets here. This is a stock, but the awesome thing about the wave principle is that it's equally applicable to any freely traded market. So whether you're looking at a stock, a currency as we do in Maverick Currencies, of course, whether that's fiat or crypto, it doesn't matter. Commodities, doesn't matter. Fixed income products, it doesn't matter. These patterns will repeat themselves over and over and over again. And that's the awesome thing about technical analysis relative to fundamental analysis. Just as a quick side note, a chart is a chart is a chart. What drives the currency markets is going to be the same thing ultimately that drives any other market, which is buying and selling pressure and market sentiment. Which is what technical analysis measures. So in this real world example of Graco, here we have a zigzag for wave A. We have another zigzag for wave B, which again, notice how it breaks above the wave A, the origin of wave A right over here around $50 in Graco. And then we get a 5-wave decline in wave C. And notice wave C does not make a new price extreme below the low of wave A, and we get a surge of buying pressure shortly after. So this running flat in Graco suggests again that there's hidden buying pressure. Right. So moving on to the S&P 500 index, here we have an expanded flat. This expanded flat started way back in 2018, and wave A is its own expanded flat. Notice that, A, B, and C. Wave B here is its own, is a zigzag, all right? We made a new high, all right, leading into the COVID highs of 2020, all right? This is a 3-wave movement, a zigzag. So yeah, it was a melt up. A lot of traders were on the wrong side of this move, and a lot of people went short the market. Probably a lot of people went short once we broke below the wave A support here, and then they got trapped as the 5th and final wave of wave C came to an end, and then we had a huge melt up in the other direction. Okay, taking a look now at a currency. All right, so this is a currency price chart. Notice we have the impulsive move to the downside labeled 1, 2, 3, 4, 5, and then we have an expanded flat. So this is actually a cryptocurrency. I believe it's Solana. So here we have a zigzag for wave A, B, C. We have another zigzag for wave B, and then we have a 5-wave movement to the upside for wave C. And you can notice once wave C completed, we went on to make new lows. So I hope this video was helpful in terms of going over one of the core patterns here, one of the core corrective patterns, right? Like I said, this is a sideways pattern. This is our typical base, okay? Flat patterns usually show up as bases. They tend to move sideways. The difference is sometimes at a higher degree of trend, the base, it can't be traded as a base because we get those new price extremes in wave B and occasionally in wave C, as we see here with the S&P 500. But they are sideways time-based corrections, and they occur on every single time frame. So the most important takeaway from this video, okay, is that when you see a movement in 3 waves, be on high lookout for potential traps, ways that the market can trap you. All right, so this example in Solana is great. A lot of this was an ABC movement in 3 waves to the upside. Notice how when we broke the support, instead of the market continuing to crash off, it was in fact a fake breakout, a fake breakdown. And then as we made a new high above wave A, a lot of people would see this as resistance, and rightfully so. Traders got trapped as we completed the flat, and then they got stopped out on the way down. So this is the best way to filter false breakouts. It's by correctly identifying flat patterns. So again, I hope this video is helpful. If you have any follow-up questions, if you think you've spotted a flat on your price chart and you want me to take a look at it, just please shoot me an email. More than happy to help. So again, guys, this was Imre. Thanks very much, and I look forward to seeing you in my next video.